We are back, and as always, we sure to appreciate you being with us. You know, it is time for our new Monday feature. We are calling it Wealth Within with Dale Gillham. He is the founder and executive director of Wealth Within and author of Accelerate Your Wealth. It's your money, your choice. He is also Australia's #1 wealth financial guy, stock guy. Dale, welcome back. How are you doing this week?
Oh, look, thanks. I'm doing fantastic, Jim. I hope you and all your listeners are doing great as well this week. It's a fantastic week.
Yes. All right. So we had a weird week on the stock market. We lost 700 points on Monday, rallied back. What was your take on last week?
Yeah, I remember last week I said I thought the market would be a little bit sort of subdued, maybe rise about 1%. Instead, it fell away very early in the week on the China trade war, which I still think is a bit of a non-event. I think both the US government, or Trump, and the Chinese government, they've obviously read The Art of War by Sun Tzu, and they're postulating between each other, trying to take a position. Because at the end of the day, it's like they both need each other. They really do. I mean, the US relies on China. China relies on the US. So I think it's just trying to get a bit of leverage to get a bit better deal for their countries, which you can understand. Trump wants the best deal for the US as he possibly can, and I totally respect that. So, but can we just get on with it so we can get back on with business? So
I'm
really
tired
what
of
it's
talking
about.
about. Yes. Yes. Let's talk about some specific companies. We are watching, of course, Uber right now with their IPO, their float about 10 days ago now. What are you seeing with them?
Look, I still think Uber is going to fall away. I don't think it's a great stock to own. It did held up a little bit during the week. It started off down, as you know, on the float. It fell away. It fell away a little bit earlier in the week, but came back not too bad. So there's not a lot of selling at this point in time. But what happens with a stock like this, as it slowly floats down, people who bought the float are very, very excited about it and really think it will be, another big stock like a lot of the FANG stocks. Now, that may be the case in 5 or 10 years, but right now I don't think it's got the legs to do very well. So as it falls away, you'll start getting some of those people that were thinking they were going to make a fortune quickly start selling their shares, and it'll drop away a little bit better, and we'll be able to buy it anytime in the next 12 months cheaper than you could have bought it off the float or off the prospectus. So I think
would you consider it
now.
a buy then? Would you even think about buying it at a lower price 6 months
I
from now?
would. Yeah, I'm much more of a technical analyst than a fundamentalist. So whilst I have a lot of philosophies that are very similar to Warren Buffett, the ultimate value investor, I'm more of a timing the market person. So I'll buy stocks low and sell them high rather than look for value investing. I don't hold stocks for more than sort of 9 to 18 months. It's nothing long-term buy and hold with me at all. So once it falls away and I get some certainty around the direction of it, and it starts to get some strength again, it'll tell me, and then we can bring it up one day, and I'll say, okay, now's the time to buy Uber. Facebook, Apple, Amazon, Netflix, Google, all looking really good now, much better stocks to buy. Facebook is looking good. I think Facebook will go up in the next week, probably into the next month, and probably even make a new all-time high. But I do like those stocks because they fell away quite heavily last year. It's about 35%. A lot of them, I think one actually fell about 40. So they're all coming back from that now. So it is looking good.
And Facebook, one of the founders, came out this last week and said the company needs to be broken up. Is that any threat at all? Does Zuckerberg really face any threat from maybe some of the fines or anything like that?
Well, as companies evolve, they do evolve into certain different areas. And so we do see companies split off different divisions to do specific things. And I don't think that's a big issue. But right now, Facebook they're going through a little bit of a tough time, obviously, with the new laws in Europe regarding intellectual property, music, videos, movies, all those sorts of things. That worries YouTube very, very much. And it also worries Facebook and all the other sort of social media companies out there. So they're just trying to figure it all out at this point in time, how far they go, what they've got to do, how they protect it. Obviously, Facebook's also about privacy as well. They've been slammed a few times on privacy issues and leaking of data, that sort of stuff. But, they'll sort it out. They're a big company. They're well managed. They haven't got to where they've got by making a lot of mistakes. That's for sure.
And what about the week coming up? So I've been hearing some talk, it was on two of the stations that I watch, about the market being a little bit overpriced. What are your thoughts on that?
Yeah, they do. There's a lot of talk around that the market is overvalued. Now, the interesting thing between the S&P 500 and the Dow is there's slightly diversion between that. The S&P's made a new high more recently where the Dow hasn't. But so what is undervalued? But they're measuring over undervalued by using PE ratios and simple terms for the listeners. A PE basically means what are you paying for $1 of the company's earnings? So basically how they calculate it, they get the earnings per share, they divide it into the current stock price to come up with their PE ratios. I'm not a big PE ratio investor. As I said, I'm much more of a trader which buys low, sells high. But there is talk of the S&P 500 being overvalued because its current PE is around 21, I think 21, 22. Standard PE ratio for the S&P 500's around 15 to 16 with the median around about 14. Its highest has been 123, which is during the tech boom, which you saw in the early 2000s. But right now, what's happening is it just means that it should slow down a little bit. It doesn't mean crash. It just means the S&P might need to slow down so the PE ratio comes down a little bit. But I don't think there's too much to worry about it. Generally, what you're looking for in a pullback will be around about every year the market will fall back sort of 5 to 10%. Then every 4 years are sort of around 15 to 20%. The S&P fell it down 20% into nearly December, into mid to late December. And so it's coming back at this point in time, but it probably just slow down for a little bit to let the PE ratios balance out a little bit. But I definitely don't think there's going to be a crash, that's for sure.
All right, so I don't understand one thing. If the current PE ratio is around 21, 22, and historically it's 15, 16, that means by definition we are overpriced. I don't see how that's
Absolutely.
Not. Okay. But it's not a worrisome overpricing.
No, you shouldn't be too worried about it when it's overpriced. I mean, it's only slightly overpriced, about 20% overpriced or 20, 30% overpriced, but it's not really a big issue. It's a lot of the media push out these sorts of things saying, hey, it's overpriced, and analysts do because they want the market to come back a little bit so then they can take advantage of it. It's looking long term. I still think the S&P and the Dow both look really, really nice. I think they've had a little bit of resistance at the current levels that they've got, but I think they'll break through that. I think there's probably at least another 10 to 20% left in the S&P 500 growth I'm talking about going up before it comes down into another major low. But for listeners, it's not about listening to what the whole market does because you can't buy the S&P 500. Most people can't even afford to buy all 30 stocks on the Dow. You just have a portfolio, as I talk in my book, of between 8 and 12 shares, and that's all you need to worry about. And as long as you've got your downside risk cover, it doesn't matter what the market's doing, whether it goes up or down. So I talk about using stop losses and exit strategies, and we'll probably get into those over the coming weeks and months anyway, a little bit more. But for people who read my book, always let the upside happen and protect your downside. So it doesn't matter to me whether the market comes back at all. I'll be protecting that downside risk on my stocks, not necessarily the market.
I don't understand that, Dale. How do I protect the downside? That's one I'm not sure about. Tell me about that.
Yeah, you just have an exit strategy. There's a few that I talk about in my book. So one of them, it's a real easy one to do. If you're in profit on a stock and it falls by 15%, you just get out of it. It's pretty simple. Just by calculating 15%. But there are various different little trailing stops that people can actually do. One of them is a trend line, which I teach in my book. And if you've got a ruler and a pencil and you can draw a straight line with that, then that's pretty much all you're going to need to use trend lines and just bring up a chart. But the thing is people think their stocks are going to do exactly what the market's going to do. If the market's going up, my stocks will go up. If the market's going down, my stocks will go down. That's a myth. It doesn't happen like that. There are stocks that will go counter to the trend of the whole market. So to me, is always have an exit strategy, whether it's a trend line or whether that's 15% off a buy price or whether it's 15% off the recent high price. So let's say that a high price of a stock is $100 that you own. It drops by 15% of that. You just exit and put your money back in the bank and then look for another stock. And you won't find all of your stocks falling with the market. They just won't do that. They won't. That some will still be going up. The ones that are going down, you just get out of those. It's just about proper portfolio management and risk management.
So a pencil, a ruler, and a straight line, does that not rule out most American investors right there, Dale?
You're saying that everybody in America can't draw a straight line, are you? Well, they don't have a rule and a pencil.
You're not going to argue with me on that point, are you?
No, I'm definitely not going to argue with you on that point. But I think it's pretty simple to get in and get out of stocks. And I think most people focus on getting into stocks rather than managing their portfolio. And the most important thing you can do with your portfolio is always manage the stocks that you're in and exit them. Learning how to exit makes you far, far more money than buying any stock. And I think investors almost throw darts at a dartboard to pick stocks. They hear some good news on something, they go in and buy it, but then they don't know how to manage it. And it's like jumping in a car. If I could put you into a Ferrari and you go, hey, great, I'm going to get in this really fast car. And then I go, hey, Jim, by the way, before you take off, the brakes aren't that real cool. Like they may work, they may not work, so go for a drive. You're going to get out of that car straight away. It's learning how to stop and get out and protect yourself that'll make you far, far more money on the marketplace. And I think people need to learn just some simple strategies about exiting, and they will take profit, because one of my rules is what you do not lose determines how much you make. So if you don't lose a lot, it doesn't take a lot to make it up.
So Dale, we only have about 10 seconds left. What's the market going to do this coming week?
Oh, look, I think it's going to go up a little bit. The S&P might go down a tiny little bit. The Dow looks like it's going to go up a bit. So it's probably going to be another one of those weeks where it's a bit of indecision, up and down. But hopefully it'll end up about 1% up.
I hope so too. Dale Gillham, everybody, Wealth Within, and the book, Accelerate Your Wealth. It's your money, your choice. Dale, thanks for all of the tips, and we will be back next week and get some more. Thanks a lot.
My pleasure.
And we are out of time. I hear the music, which means we have to say goodbye. We will talk to you tomorrow with more great School for Startups radio. Bye now.